Most people think of life insurance for the death benefit, but there are many benefits while you are alive. Now, I am not one of those advisors running around saying that permanent cash value life insurance is the best thing since Netflix, but there is significant value in tax-free accumulation in a low interest rate world and tax-free asset transfers in a potentially high tax future. Now, I started out in the investment industry in the year 2000, right in the middle of the dot-com boom and subsequent collapse. I was trained that it was best to buy the cheapest term life insurance you can get and invest the difference, because the only reason to have life insurance was to protect your family in case you died. Now, I worked for a large Wall Street investment bank. No coincidence that the strategy was to invest the money, not buy insurance. At the time, everyone was investing in tech stocks, and I mean everyone, even the taxi drivers, because there wasn't Uber or Lyft back then. At the time, I saw investor presentations forecasting 12% returns forever. If you weren't making 30% on a stock in a year, you were fired as a stockbroker. Expectations were just outlandish. You know what happened, right? The tech-heavy NASDAQ peaked on March 10th, 2000, a level it would not reach again for 15 years. Yep, 15 years of zero returns. From that March 2000 peak all the way down to the trough it reached on October 9th, 2002, the NASDAQ would lose nearly 80% of its value. In fact, in April 2000, which was 1 month after peaking, the NASDAQ had lost 34.2% of its value. It was then that I began to think differently about life insurance. What if everything I was taught was wrong? Well, probably everything wasn't wrong, but what if I didn't know the whole truth? So I started doing my own research and was astounded by what I learned. Stick with me and I'll discuss the pros and cons of one of the most misunderstood financial planning tools around. Colin Exelby here, and I provide financial planning for business owners and their families that just makes sense. I own the financial advisory practice Celestial Wealth Management and have over 20 years of experience providing advice to clients all over the country. Did you know that the single largest asset on most banks' balance sheet is permanent life insurance? I didn't. Did you know that after paying for insurance costs, extra funds put into cash value policies grow without taxes? I didn't. Did you know that you can maintain access to those funds to use for any purpose? No approval needed from a loan officer and no penalty like in a retirement account for early withdrawal. I didn't know that. Did you know that you often maintain access to roughly 75% of the contract cash value right out of the gate if you need it? I didn't. Did you know that in today's environment, typically in a whole life insurance contract, the interest rates credited are between 4 to 6% based on the current dividend rates and never negative? And remember, those rates are not taxed and could go even higher if interest rates increase. Well, I didn't know that. Do you know that if you're sued, assets in life insurance offer creditor protection? I didn't. Did you know that life insurance passes tax-free to your heirs without any of the limitations that IRAs and 401ks have? I didn't know that either. Life insurance is more flexible than almost any financial planning tool without taxes or distribution rules to worry about. Well, that sure is different from the dot bombs of the early 2000s. Look, there is a lot about permanent life insurance I didn't know when I got started in the advice business. It's taken me years to learn the ins and the outs so I can easily understand how so many people run the other way when permanent insurance is brought up. This is a good spot to point out important disclosures. The information in this video is for educational purposes. This is not specific financial planning or investment advice. In addition, everyone's tax situation is different. You should discuss your tax situation with a qualified tax advisor before implementing any planning strategy. Will the stock market implode like in the year 2000? I have no idea. It could triple from here, it could fall by 50%. No one knows. And if they say that they know, run the other way. After taking into account expenses for a permanent life policy, in my opinion, it could be a very attractive addition in this low interest rate environment. Will it outperform the stock market over time in a Roth IRA? Probably not. I mean, I really doubt it. That's why I've got a Roth IRA. But will it do better than having money in checking and savings accounts, CDs, or low-yielding bonds? It very well may, especially because it isn't taxed. If you earn 4%, just 4% in one of these policies tax-free, and we're in the 22% tax bracket, you would have to earn 5.128% before tax to do better. What bank account, CD, or bond is paying that? Now, many of us follow widely held truths without actually doing a little digging. Now, I am skeptical of almost everything, so the whole buy term and invest the difference strategy deserved a little more digging. First, when you buy a term policy, it is typically a level death benefit, like $500,000, $1 million, $2 million, which means due to inflation eroding its value each year, a term policy purchased decades ago is worth far less in inflation-adjusted dollars. Second, according to a Penn State University study, 99% of term policies never pay out a claim. Now, thankfully, most people don't need them, and they let the policy lapse, but the dollars that are spent are gone forever. Third, how many people actually seriously invest the difference between what they would pay for a term policy versus a permanent one? Well, according to David Babel, a professor at the Wharton School of Pennsylvania, quote, "People don't buy term insurance and invest the difference. They most likely rent the term, lapse it, and spend the difference." Now that is American. For those that actually do invest the difference, what happens to the funds? Well, they typically go into an account where interest income is taxed and capital gains are taxed over time. Since 2000, the typical stock investor lost 49% or more of their savings not once but twice. According to the famous annual Dalbar study, the typical stock mutual fund investor earned 4.25% annually over the past 20 years ending December 31st, 2019. Now that's less if you're in the 22% bracket than what we talked about earlier. Over the same time period, the S&P 500 earned 6.06%. Now, you only got that return if you were invested 100% in stocks at all times and never panicked during those huge drops. And those gains are taxed along the way at whatever the government says that they should be taxed. Now, it's true that permanent life insurance policies can be more complex, and they can be more costly because of all the benefits that come with them. Also, not everyone is insurable. They're generally long-term planning vehicles and have policy premiums that need to be paid to keep the policies in force, whether through deposits or dividends. And if you withdraw cash, borrow, or use cash value to pay premiums, you do reduce the death benefit. It's also true that they are more inefficient in the early years as the policy gets going, but the longer they are held, the more efficient they become. It's kind of like an airplane flying from New York to LA. As the plane takes off from New York, it's full of jet fuel and takes a while to get up to cruising altitude. But once there, as jet fuel burns off, the plane gets more efficient and flies faster. It's the same with many permanent life policies. The longer they are in effect, the longer tax-free compounding of interest and dividends can occur. And if you structure these policies correctly with an agent that is looking out for your best interests, you can have a growing death benefit instead of a static one that benefits your heirs, and you can access the funds tax-free later on in life for that tax-free retirement income. How do you do that? You borrow against the policy value. Well, you must have to pay really high borrowing rates, right? No, borrowing rates are stated in the contract and typically 4 to 5% in this current rate environment. Hey, quick little plug here. If you are enjoying this video, make sure you give it a like, and of course, smash that subscribe button, hit that little bell so you know whenever I release a new financial planning video. All right, have you heard the saying, buy, borrow, die? That means buy assets, borrow against them to provide cash flow, and then die. Many wealthy clients implement this strategy to minimize taxes. When do you pay tax? Well, if you save in a non-IRA, you pay taxes typically at 15 to 25% of gains and potentially more if rates are increased. In retirement account distributions from IRAs and 401ks, you pay taxes if it was income, right? Typically double-digit rates, unless you're properly structuring your assets for a 0% tax bracket. So, is borrowing at 4 to 5% interest better than paying 15, 20, or 25% in capital gains tax? I think so. Permanent insurance structured correctly can be an excellent strategy for a tax-free retirement. Now, we just learned about all the benefits while we are alive, but what about passing on what we don't use? If you are diligent in your planning, you most likely will have assets that you would like to pass along to the next generation. Ideally, you want to do that tax-free and pass on as much after tax as possible. Well, when Congress unleashed the Secure Act in 2019, it eliminated the Stretch IRA. Man, the Stretch IRA, that was previously around since the 1970s, and it made possible for those inheriting an IRA to take out proceeds over their lifetime, potentially lowering taxes. And I've got a number of clients that are utilizing that. Well, with the Secure Act, it says that you must withdraw all inherited IRA assets within 10 years unless you are a spouse or eligible designated beneficiary, or EBD as it's called. So, Congress just made traditional IRAs much less attractive to leave for beneficiaries. That's moved permanent life insurance to the top of the list for efficient estate planning. Now, do you have a spouse who will inherit your IRA at some point and then owe taxes in the single tax bracket once you pass on? Many couples forget that the odds are one of you will live longer than the other and will pay what is referred to as the widow's tax. The fact that you have the same income and assets but are now taxed as a single individual rather than married couple at much higher rates. And the government is counting on it. Wouldn't it be great to have an insurance payout that could help him or her convert those funds to a Roth IRA and pay the tax for them? I know I would love that. Roth IRA, HSA, and permanent life cash value for the tax-free win. You know what else is a win? This next video. You will want to watch this video next, a pillar of the buy, borrow, and die strategy that provides tax-free cash, the reverse mortgage strategy. Get clear, be clear.